Hi, I'm Blain, strategist for Shard Capital, normally based in London, but like everyone else, working from home through this crisis. Over the last few days, we've seen some spectacular market moves. The markets rebounded from what apparently looked like the low, stimulated by government packages, QE infinitive, and interest rate cuts. Governments have said they will do whatever it takes to support economies, and we're even hearing talk of helicopter money, money going directly into consumers' pockets to drive demand. As a result, the markets have rallied spectacularly. But let's be honest about what that actually means. It means that the markets are arbitraging, that do whatever it takes. They are not buying markets based on fundamental expectations of where this crisis is likely to take the global economy. And if you were to look at where the economy is going to go, it's worth reading some of the latest thinking and surveys that have been done of institutional investors. A recent one showed that over 65% of global risk managers, the chief risk officers, expect that this is going to take longer than 3 months to fix, and there is a better than 50% chance that the globe tumbles into depression. That's where global GDP declines by more than 15%. What is clear is that the effects of the coronavirus are not going to end anytime soon. And one of the places that we really should be looking for clues is the corporate bond market. Immediately on the crisis beginning, corporate bond spreads widened dramatically because investors reckoned that it would mean wider cash needs. And certainly over the last few weeks, we've seen a desperate scramble as corporates try and raise as much cash to get them through what is likely to be an extremely poor first and second quarter of 2020. But more so, investors are concerned that there are going to be a rising number of defaults by companies that are heavily leveraged. These are the ones that borrowed loads of money on bond and loan markets in order to buy back their own stock. And it's also likely we'll see a large number of downgrades that will take many companies into junk bond territory. As a result, many institutional investors will be forced to sell, and at the moment there is really no liquidity in markets. Yet what we saw after the success of all the government support packages and the rally in the stock market was a reopening of bond markets. Even junk companies have been able to raise more money, and that's because investors are looking, seeing higher yields and thinking they want to lock them in now. But I'm afraid that's likely to be a very short-term thinking because we have not seen the real effects of coronavirus across the global economy yet. We haven't seen what the result of effectively 3 months of non-production is going to do to economies. We haven't seen the unemployment rates hit the peaks that they're going to do. And even though governments like Britain have promised to keep everyone paid, it is going to cause enormous financial stress for households. And when households are financially stressed, they're not spending. That would look like it's going to be deflationary, but let's think about the other side of that, inflation. At a time when we aren't actually producing anything, but people are still buying, that means fewer goods and the same demand, which usually ends up in higher prices. Now, if we see higher prices, especially in food, that's going to generate unrest. So it is entirely possible we could still yet go to some kind of rationing system, which is going to cause further economic pain and especially more questioning about what governments are doing. And there are other long-term implications to be thinking about as well, and how they are likely to change market imperatives. And one of these is going to be healthcare. It's absolutely clear that the West has failed to prepare properly for this crisis. And the reason for that isn't really surprising. We've just had 10 years of austerity following the last financial crisis. And even though all the scientists were advising that it was very likely that at some point we were going to get another epidemic out of the East, it wasn't an immediate threat. It was a threat, but it wasn't immediate. Therefore, it was something you could push off the spending till later. As a result, when it happened, we were unprepared. Contrast that to what's happening in the East, where countries very quickly adopted draconian measures to stop social contact, but also followed up with very strict contact tracing, which meant they contained the virus. These economies, China, Taiwan, Macau, and Singapore, are all coming out of this very much quicker than the West, and that's going to be another thing that will change the global environment. What chance now of trade agreement between China and the US? China will come out far quicker, and China is going to flex its economic muscles. This still has far more to develop, and I'm sure we'll be talking about more on this in coming weeks.